The metal already moved, the crowd already noticed, and the only thing still pretending nothing changed is the mining share tape. Gold has been sprinting through January, pushing into the high 4,000s and flirting with that psychological 5,000 airspace, while a lot of miners have been acting like still waiting for a permission slip from the equity market. And that gap is not a trivia fact. That gap is pressure. Because when gold moves like this, it doesn't just change headlines, it changes balance sheets, hedging behavior, and the way real money allocates risk. But the catch is this: the first wave almost never shows up where retail expects it. The first wave shows up where size can move instantly. And the second wave, when it hits, tends to hit the laggard with torque. That's where the real pressure starts. Here's the conflict in plain English. Gold is behaving like a macro asset that just got re-rated. It's not inching, it's stepping. It is the kind of move that forces every portfolio manager to answer the same question. Do I have the right amount of store of value exposure if volatility stays elevated and policy risk keeps leaking into markets? Meanwhile, miners, especially the broad miner basket, have rallied, yes, but they've also hesitated right where they were supposed to hesitate, near the big prior highs, the places where supply lives, the places where sellers say, okay, prove it. And if you're watching this setup correctly, you're not just watching price. You're watching who is being forced to do what. Because if this one level breaks, the math changes. Let's get one thing straight early because it's the source of most confusion. A mining share is not a gold bar with a ticker. It's a leveraged business with costs, capex decisions, political risk, labor risk, energy inputs, FX exposure, and an equity risk premium stapled on top. That means miners can lag even while gold is ripping. Not because the thesis is wrong, because the instrument is different. Gold can be bought as pure exposure. Futures, large OTC blocks, ETFs, clean, liquid, immediate. Miners are an equity claim. They live inside equity frameworks. They get punished when broad equity volatility rises. They get punished when people fear dilution. They get punished when costs might be rising. They get punished when risk-off hits the tape. And the weird part is that punishment can persist right up until it can't. But that's not the part that matters. The underappreciated detail, the hidden detail that flips this whole story, is that miners usually start catching up just because gold is higher. They start catching up when gold becomes financeable inside risk systems. That sounds abstract, so let me make it concrete. Big allocators don't just like a trade, they size it. They put it into a risk bucket. They ask how it behaves when rates move, when equities gap, when vol spikes, when liquidity thins. Early in a gold surge, the metal can be violent. It can jump on a headline, reverse, gap again, and whipsaw everyone who tried to chase. In that phase, the cleanest choice for institutions is often the metal itself, because they can hedge it, they can scale it, they can exit it. But when the move starts acting like a regime, not a rumor, when the volatility of the move compresses even as price holds, then the internal calculus shifts. That's when miners stop being too messy and start looking like the torque sleeve. And that's where the flow shift usually comes next. Now look at the scoreboard. Gold has been marching higher through January with multiple sessions printing new highs and the broader narrative turning from, is this a spike, into is this a new plateau? Meanwhile, the miner ETF has put together a strong rally of its own. But the key is the behavior around the upper zone, roughly that 105 to 107 area that S been acting like a ceiling. Think about what that means. If you're a manager who missed the early part of gold's move, you don't want to buy the metal right under a giant psychological number and then watch it snap back 5% on thin liquidity. That's career pain, but you also can ignore a market that S screaming macro stress with record prints. So you do what managers always do. You wait for a structure, you wait for a line, you wait for a retest. And miners sitting under their own line become the obvious, if it confirms, I can justify it, vehicle. And that's where the real pressure starts. This is why the lag itself is information. When the metal runs and miners don't immediately explode, it doesn't automatically mean miners are broken. It often means the market is still pricing the excuses. Costs, politics, general equity fragility, the habit of miners to destroy value at the top by chasing deals. The scar tissue is real. Investors remember cycles where gold went up and miners still underwhelmed because management teams diluted shareholders or paid too much for acquisitions. So the default stance is skepticism. And skepticism is exactly what creates asymmetry, when the tape finally forces a re-rate. Because when a skeptical market is wrong, it moves fast. Not politely, fast. Let's talk mechanics, because miners lag isn't a vibe, it's structure. Gold is primarily traded in deep derivatives markets where price discovery is immediate. Futures markets set the pulse, and ETFs translate that pulse into equity flows. Miners are one step removed. They're a claim on future cash flows generated by producing ounces. And those cash flows depend on the spread between realized gold prices and all-in sustaining costs. When gold spikes, investors ask, is this durable enough to change free cash flow guidance? Or is this just going to fade, leaving everyone holding equity risk for nothing? In the early part of a surge, the market often refuses to price a full earnings re-rate until it sees persistence. That's not conspiracy, that's risk management. But here's the catch. Once persistence is established, miners can shift from we done trust it to we can got be underweight this in a handful of sessions. And the next detail is what flips the whole setup. That detail is options reflexivity. You don't need a graduate degree to understand the core. When an ETF like the miner basket starts trending and call buying increases, market makers who sold those calls hedge themselves by buying the underlying. That buying can amplify the move, which can attract more call buying, which can force more hedging. It's not magic, it's plumbing. And it doesn't always happen. But when it does, it turns a normal breakout into a squeeze-like move where the path becomes discontinuous. People look up and say, why is this moving so fast? Because hedgers don't buy on feelings. They buy because the math tells them to. And that's where the real pressure starts. Now layer in the calendar because why now is not optional. Late January is a dangerous time to be complacent. Month-end rebalancing forces institutions to sell what outperformed and buy what underperformed, just to keep allocations in line. Funds that run mandates don't get to shrug at drift. They have rules. At the same time, liquidity can thin unexpectedly as markets position for upcoming policy and geopolitical deadlines, and thin liquidity makes moves look bigger than people expect. Add in the reality that we re-staring at a near-term calendar catalyst, tariff threats and geopolitical bargaining that can hit markets like a hammer, and you have the perfect recipe: higher uncertainty, higher volatility, and a strong bid for defensive stores of value. But that's not the part that matters. What matters is what that environment forces participants to do. It forces discretionary managers to reduce overconfidence in crowded equity themes. It forces risk parity and volatility targeting strategies to rebalance. It forces hedgers to look for convexity. It forces macro funds to express views in instruments with liquidity. And the first instrument they touch, again and again, is gold itself. That's why you see the metal moving first. Then, if the move holds, the next step is to hunt for torque. Where's the torque? It S in the equities, whose earnings explode when the realized commodity price rises while costs lag behind. That's miners. But it's not automatic. The market makes you earn it. It demands confirmation. And the line it's watching is sitting right there. So let's talk about that line, because this is where most people either get trapped or get paid. In the miner basket, the 105, 107th region is not just a number, it's a memory. It's where supply previously overwhelmed demand. It's where late buyers got punished. It's where sellers feel smart. A breakout above that zone is not meaningful because it looks bullish. It's meaningful because it signals that a large cohort who wanted out is now out, and new buyers are willing to pay higher prices even with everyone watching. That changes the probability distribution. It turns rallies from sellable to ownable. And in a market where gold itself is pressing into a psychological ceiling, that minor breakout can be the cleanest signal that the flow shift has begun. And that's where the real pressure starts. Now, before we get carried away, here is the part bulls tend to avoid. Miners can absolutely keep disappointing even with gold strong. This is not a guaranteed script. It's a setup. It has invalidations. It has landmines. Costs can surge. Fuel, labor, reagents, and sustaining capex don't care about your chart. Governments can change terms. Mines can have operational issues. Management teams can do dumb things, buy high, dilute, chase production for ego instead of cash flow. And on top of that, miners still trade like equities. If the broader equity market hits a sharp risk-off event, miners can get sold with everything else, even while gold holds up. That's why you need a process, not a prediction. Because if you don't have a process, volatility will use you. And volatility is the market's favorite weapon. Here's how that weapon works. The market makes you feel late on the way up and stupid on the first pullback. It spikes the open, then fades all day. It prints a scary red candle right after you buy. Then it rips when you sell. That's not personal, that's liquidity. Professionals know where emotion lives. They know where stops cluster. They know when headlines can be used as cover to move size. So the psychology shield you need is simple. Separate trend signal from noise. Trend signal is what holds on the close, what survives the retest, what improves relative strength. Noise is the intraday drama engineered by thin liquidity and crowded positioning. And that's where the real pressure starts. So what's the proof stack that this isn't just a story? You need layers, not one argument. Start with the macro layer. Gold is not creeping higher. It's moving with urgency, which usually implies a mix of falling opportunity cost, rising uncertainty, and a bid for reserve-like assets. Then the institutional flow layer. When large allocators perceive regime risk, they prefer liquid expressions first, which is why the meta leads. Then the market structure layer. Once miners begin to break key resistance, options hedging and systematic strategies can amplify the chase. Then the supply chain layer. Gold supply doesn't respond quickly to price, so demand shocks and reserve flows can dominate for longer than people expect. Then the behavioral layer. Miners are a hated asset class in many circles, which means positioning can be light, which means the move can be violent when it turns. You stack those layers, and the lag stops looking like a failure. It starts looking like stored potential energy. Let's make the supply chain point tangible, because people confuse gold with industrial commodities. In oil, high prices invite supply response. In some base metals, high prices can trigger scrap supply, substitution, and faster project pipelines. Eventually, gold is different. New mines take forever, permitting, financing, building, ramping, years, recycling moves, but not enough to instantly flood the market when sentiment shifts. That's why gold can go through phases where price is driven more by demand for a monetary hedge than by immediate supply dynamics. When that demand is being fed by geopolitical uncertainty and policy drama, the high price fixes it argument loses power in the near term. And that matters right now, not in 5 years, because your time frame is this week and this month. Now zoom back into miners and talk profit mechanics. Miners are basically a margin story. Revenue per ounce is tied to gold. A chunk of costs are sticky in the short run. When gold rises faster than costs, margins expand. When margins expand, free cash flow expands. When free cash flow expands, the conversation changes from can you survive? All to how much can you return? Buybacks, dividends, debt reduction, capex discipline. That re-rating is not linear. It can be sudden because equity markets price future cash flows, not today's. The market starts asking, if gold stays elevated, what are these companies worth? And suddenly, the multiple that used to feel fair looks too cheap. But that's not the part that matters. The part that matters is how that re-rating typically enters the market. It doesn't enter as a heartfelt realization by the masses. It enters as a forced decision by managers who are underexposed. Think about the psychology of institutions. If gold is surging and they're underweight, they can buy gold exposure quickly. But if gold starts to consolidate near the highs, if it stops being a one-way momentum chase and starts being a platform, then owning only the metal can feel like owning the safe version of a trade that is still paying. That's when they ask, where's the torque? And they look at miners. If miners are still lagging, the trade is attractive because the relative value looks compelling. If miners then break out, the trade becomes urgent because now you have both relative value and momentum. That's how flows turn from consider to must, and that's where the real pressure starts. So here's the near-term roadmap. Over the next week or two, the setup will reveal itself through a checklist the market can't fake. First, watch whether the miner basket can hold above the round number zone near 100 on pullbacks. That's a sanity check. If it can't hold 100, you're likely in a choppier, mean reverting environment where rallies get sold and you need patience. Second, watch that 105-107 ceiling. A clean push through, followed by a retest that holds, especially if it holds on a closing basis, is the kind of confirmation that systematic money respects. Third, watch gold's behavior near the psychological 5,000 neighborhood. It doesn't need to blast through in a straight line. In fact, a controlled consolidation under the big number can be bullish because it tells you demand is absorbing supply without panic. Fourth, watch volatility. If you see miners become less reactive to scary headlines, if down days are smaller and recoveries are faster, that suggests better hands are involved. And the next detail is what flips the whole setup. That detail is breadth. Miners are not one thing. There are seniors, mid-tiers, producers with clean balance sheets, names with geopolitical risk, names with cost problems. In a healthy miner catch-up, you don't just see one or two heroes. You see broad participation. You see the ETF lead, then quality names follow. Then the riskier names begin to move as the market's risk appetite increases. If you only see a narrow move where a couple of stocks carry everything, that's fragile. If you see broad breadth, that's allocation. Allocation is durable. Durable moves create reflexivity. And that's where the real pressure starts. Now we need to address the institutional suppression narrative carefully, because it's easy to cross into cartoon land. Markets have incentives. Banks and large participants manage risk. Futures markets can be used to hedge, to arbitrage, and yes, at times, to lean into liquidity pockets. But you don't need a conspiracy to explain what's happening. You just need incentives. If big participants can express gold exposure in a liquid instrument, they will. If they can hedge options efficiently, they will. If miners are messy equities and the market is nervous, they will hesitate. And when that hesitation clears, it can look like a sudden awakening. It's not magic. It's the moment when incentives shift. In a risk-managed world, That shift often happens right after the move survives a scary test. That's what you're watching for. Let's map the two scenarios because this is how you stay credible and sane. Scenario 1 is the controlled pullback and retest. Gold pauses, maybe pulls back a bit from the highs, but it doesn't collapse. The miner basket dips toward support, maybe around 100, maybe even the high 90s. And then buyers show up. You see it in the closes. You see it in the way dips stop getting extended. In that scenario, the lag narrative becomes a springboard. It lets the market reset without breaking the structure. Then a second push tests the ceiling again, and this time it goes. That kind of sequence tends to build trust. It invites the kind of money that wants confirmation, not adrenaline. Scenario 2 is the continuation squeeze with gap risk. Gold rips closer to the big number and headlines intensify. Liquidity thins. Miners punch through the ceiling without offering a clean entry. You get gap ups, violent intraday swings, and a sense that the market is running away from underpositioned managers. In that scenario, the danger is not that the thesis is wrong. The danger is that volatility is used against you. You'll be tempted to chase. Then you'll be punished on a sudden dip. Then you'll be tempted to quit. And the move will continue without you. The only defense is pre-commitment. Know what you're willing to tolerate, and don't let a single candle decide your emotions. Now let's define invalidation, because this is the part that separates operators from hype merchants. If the thesis is miners are lagging and a flow shift usually comes next, then the market should not behave a certain way. Specifically, if miners can T-hold key supports after attempting a breakout, if the ETF repeatedly fails the ceiling and then loses the 100 zone with momentum, that suggests the market is not ready to re-rate miner equities and the lag might persist. That doesn't mean gold can't stay strong. It means the torque sleeve isn't activating yet. Another invalidation signal is if gold's surge turns into a sharp reversal that breaks the recent structure, turning the move back into a spike. In that case, the financeable trend condition is gone, and miners often underperform because they're equities with downside beta. This is not about being right. It's about knowing what would make you wrong. And here is a subtle one. Watch for a miner rally that happens while gold is flat or down, driven purely by equity risk on. That can happen, and it can be tradable, but it's not the same thesis. The thesis here is gold-driven re-rating and flow rotation. If miners are moving for reasons unrelated to gold, you need to adjust your expectations about durability. Because the moment risk-off returns, that move can evaporate. This is why mechanisms matter. Headlines come and go. Mechanics persist. And let's also talk about the paper versus physical tension without turning it into mythology. When gold prices surge, you often see stress in how different parts of the market reflect demand. Futures, spot, ETFs, and physical premiums. The key point for your near-term view is not to obsess over one anecdote. It's to watch whether the market is signaling tightness or urgency through behavior, strong closes, persistent bid, and a refusal to break support even when headlines are scary. If you see that pattern, it usually means flows are not just tourists. Tourists buy the headline. Real allocators buy the pullback. And that's where the real pressure starts. Now, why does this matter specifically for miners right now, not later? Because miners are priced like someone still doesn't believe the move. And skepticism is a coiled spring. If gold stays elevated through month end and into early February without collapsing, the temporary spike camp gets weaker. The longer gold holds higher ground, the more plausible it becomes that miner margins are not a one-week phenomenon, but a multi-quarter reality. Once that plausibility crosses a threshold, you see the rotation, not as a slow trickle, as a flow event, first the ETF, then the quality names, then the catch-up trade becomes consensus, and ironically, that's when the easy part ends. But we're not there yet. We're still in the part where the market is negotiating belief, and that's where the real pressure starts. So how do you watch this like a pro without getting emotionally hijacked? You anchor to a few observable things. 1, the level, 105, 107 on the miner basket is the gate. 2, the support. 100 is the first must-hold area for the bullish structure to stay clean, with the high 90s as the next battleground if volatility spikes. 3, the behavior. Do dips get bought quickly, or do they bleed all day? 4, the relationship. When gold is strong, do miners finally respond with relative strength, or do they shrug? Relative strength is the giveaway. 5, the calendar. Month-end and early Feb catalysts can create forced moves, so expect gaps and don't let them surprise you. And here's the most important psychology shield line I can give you. Price can whip around violently even if the thesis is correct. In fact, the more correct a thesis becomes, the more violently the market will try to shake out weak hands, because that's how liquidity is created. If you can't tolerate that reality, you shouldn't play the torque instruments. You stick with the cleaner exposure. There's no shame in that. But if you're here for miners, understand the contract you are re-signing. You're retrading a leveraged equity expression of a macro move. The payoff can be fast. The punishment can be fast. That's why you plan the trade before the candle prints, not after. Now, let's zoom out one last time and connect the dots into a single coherent picture. Gold's surge is sending a message about the macro regime, uncertainty, policy risk, and a search for durable value. Institutions, by design, express that message first through the most liquid instruments. That's the first wave. Miners, meanwhile, lag because they're equities with scars, costs, dilution, and general risk-off pressure. But once gold's move looks like a platform instead of a spike, risk systems loosen, and the second wave often follows, rotation into torque. That rotation shows up at technical gates, like the 105 or 107 region, because that's where skepticism meets confirmation. If the gate breaks and holds, the flow shift can become self-reinforcing through allocation and options hedging. And if it fails, you don't marry the story, you respect the tape and wait. That's the difference between conviction and stubbornness. So here is your concrete, what comes next, checklist for the next 1 to 2 weeks. Watch whether miners can either reclaim and hold above that 105-107 gate, or if they pull back, whether 100 holds and becomes support. Watch whether gold's pullbacks are controlled and quickly absorbed rather than turning into sharp reversals that break structure. Watch breadth. Do more names participate on up days? Watch volatility. Does the miner basket start closing strong instead of fading? And watch the calendar. If a catalyst hits in thin liquidity, expect gaps, and don't confuse a gap with a thesis change unless the closes confirm it. Because if this one level breaks, the math changes. And near the end, let's make the community identity point without begging. If you're the kind of investor who needs mechanisms, not slogans, if you want to understand what the market is forcing participants to do, then you already know the advantage isn't to predicting the future. It's seeing the structure and reacting faster than the narrative. Stay with people who talk in setups, levels, flows, and invalidations, not guaranteed outcomes. Because the moment you start needing certainty is the moment the market can control you with noise. This minor lag isn't a reason to panic. It's a reason to pay attention. The metals move is the spark, the flow shift is the oxygen, and the gate on miners is the match point. If it triggers, you'll see it in the closes, you'll see it in the retests, and you'll feel it in the speed. And if it doesn't, the market will tell you quickly, by failing at the ceiling and breaking the supports that should have held. Either way, you don't need hope. You need a checklist. Because in markets like this, the winners aren't the loudest. They're the calmest people in the room when the tape starts moving like it has something to prove.